Well, hi everybody. It's Ken Winans and Stephanie Larson. Certainly, let's start off with it seems to be a very merry holiday, at least for people who are invested. As we had talked about in one of our previous videos, we are strong believers in the holiday season usually being good for stocks and bonds and other things that we might be buying into. So I think we're happy to see there's a Santa Claus rally. And
Yeah, especially since we didn't have one last year. It's really nice to see.
yeah, it's for all of us, I think we all can realize that it's been a very interesting 24 months. It's been a long time since I've seen multiple years where they're really, I mean, you're right now, S&P 500, Dow, a lot of the major indices, they're basically back to where they were in December of 2021. So that just goes to show how far things had to go. But what we wanted to talk to you about today was, as much as we want to certainly appreciate the positive nature of things right now, we want to talk about going from this into next year and some things for all you to consider. Number one, I generally don't like doing knee-jerk asset allocation changes to a portfolio. I would recommend that everybody gets their year-end reports. We're more than happy to have discussions about things that, I mean, this was 2023 especially was a very strange year. I've been doing this for over 30 years and it's left me scratching my head a lot of different times.
It was really difficult to manage in this year.
Very tough. If you start just off with the banks blowing up in the first quarter, and then certainly, just the topsy-turvy market we had in commodities, there are a lot of things going on. But anyway, with that being said, we're looking forward to seeing everybody going into next year, get the year-end reports. We'll set time to have meetings, talk about strategy. I think a couple of things. Number one, I mean, I think it's safe to say that unless, and this is the caveat, unless we have serious pressure of inflation due to wages increasing. I mean, there's increased calls for unionization, and it's not to get into a political discussion about these things, but just this is typically what happens. You have inflation take off, and then people are being pinched, as we all know. Things are much more expensive than they were 3 years ago. And then there's a lot of companies that are in the news today with Starbucks. Starbucks is fighting and resisting unionization. So if we have wages go up next year, that itself can be a very inflationary. The other thing I bring up, oil has had a dramatic drop really over the last month or so, and it's very seasonal. We just don't drive as much in the wintertime. And if that does pick up, we could see, and certainly with the geopolitical things that are going on, there's a lot of things that could have that happen. So anyway, the point being, at this point, we're not expecting the Fed to raise interest rates any further. And in fact, if things really do stay calm, I know Stephanie thinks that probably rates could drop off a little bit next year.
Well, I know that Ken and I have had a really healthy debate about that over the last 6 months about whether we think rates, there'll be one more hike, and then when will they start cutting? How big would the cuts be? I can tell you that what Ken was just saying is correct. The wage push is a thing in economics. It's something that we're definitely going to pay attention to, that it could increase inflation. Some of the areas that people don't really consider when they talk about inflation, they just think of cost of goods. They don't really think about payroll and housing, but those are two areas that really can perpetuate the issue. I think that what we saw today was really interesting. The Fed has obviously paused. There was debate about would there be one more hike this year. I didn't think so, and they're not going to do one. What they're predicting next year is actually cuts. The inflation numbers come down into the threes. They're very happy with that. And so with that being said, a lot of the smart business people are discussing how much rate cuts. What we were just saying before we did the video was they will. I think they're going to cut rates. It's not going to be a lot. They're not bringing it back down to zero. You're not going to see that type of environment again. Inflation's still too close out there where there's too many variables that could really accelerate it again. So the Fed's going to be conservative. I could see a quarter basis point, maybe 50 throughout the year. But if the data changes, then they can pause, they can rehike. There's a lot of things. So people are kind of optimistic, but you have to do with a slight hesitation.
We're getting ready to do we just put out a new Forbes article today that you all might find very interesting. It was a little different than anything I've done before because I rarely talk about cryptocurrencies and commodities, but anyway, you'll enjoy that. But Stephanie and I are working on our final Forbes piece for the year that's really dealing with what's going on in the bond. And remember, bond markets, there's no such thing as one market.
Yeah.
Treasuries, municipals, and corporates. And one of the things, I just looked at a chart really going back to the 1900s. And although you might say it's too far back, but the reason I'm talking about it now is that when you look at where rates are right now for municipal paper, corporate paper, they're about where it was in 2009, 2010. It's not, we're not having to go way back to find that this is just a general normalization of something that probably should have happened a while ago. So again, I don't necessarily think nor do we want rates to go back to zero ever again. That's just not healthy.
It's not healthy. I completely agree with that. And one of the things that we'll notice, part of the kind of year-end market wrap-up that we've been discussing, so we've seen the Santa Claus rally. Equities have had a really nice pickup. Actually, maybe 67% so far for the month or so. Quarter to date, really. So that's nice to see. Fixed income, on the other hand, has actually been picking up for a couple quarters now. It's not that you can't find good yields, you just have to go out a little bit further now. Today what happened with the Fed announcement, the minutes coming out essentially is that Treasuries backed up. So all of a sudden, prices and yields dropped, prices went up. And what it's going to cause is the bonds, even on the corporate side, things are going to get a lot tighter with them. So the really amazing buying window that we've had for, in reality, over a year is going to get a little more challenging to operate in. But what you see is for people that have existing portfolios, you'll notice that the bond prices are starting to go up. So our bond portfolios, especially if it's been established, is probably up about 5 to 6%. I've seen even higher. Some of the newer ones, it's going to be a little lower, but that's just because they haven't gotten all their interest for the year. So it's been a little nice on both sides of the coin lately that we are having a nice pickup. But on the fixed income side, it's going to be, I think, a little bit more traditional next year. You're not going to just enter and buy something with a 7% yield. It's just, I think it's going to be a little tougher.
I would add too, if I was asked to give themes for next year, number one, I think that everybody who has a portfolio with us that is in preferreds and in fixed income, you should expect that your average maturity is going to move out. We have said for quite a while, in fact, I did a radio interview last night with ABC down in Los Angeles, and I said it's just like somebody who surfs. You look for the wave to crest at just the right time to hop on your board. We're at that point now. And it does, standard procedure is we typically don't have rates at 3 or in 3-year range forever. It was never intended for that. It was to deal with the COVID situation and the post-COVID world.
Yep.
Now it's an issue of normalization. Normal yields, normal maturities, normal balances within a portfolio, and certainly with that. I would say on the stock market side, that we're going to be going into what I think will be one of the more interesting earnings seasons that I've seen in quite a while. And what I mean by that is you have certainly the Federal Reserve making their announcement. We have the State of the Union address of the president. We have an election year. We have central banks around the world that are all battling different things, trying to find a way to coordinate. And last but not least, guidance from corporations.
Yeah, that's going to be the big one, the retailers, to see how successful the holiday season was.
But I would say this, kind of the old phrase from the Clint Eastwood movie, The Good, the Bad, and the Ugly. I do think that any company that comes out and says we missed our numbers because our labor cost rose higher than we could contain or control, I think those stocks will be punished greatly. And by the way, I think it's agnostic to an industry. You're an individual company. I don't care whether you're a tech company in Silicon Valley or you're a manufacturer out in Indiana. If you are off the mark on your cost controls and your inventory your controls and your commodity hedging, you'll be punished because everything has gone up quite a bit.
And I actually mentioned that in the quarterly commentary from this last quarter, why earnings matter. I did a whole section of it. If you didn't see it, I actually would really recommend everybody reading it because it's really interesting. What happens, and the reason why you can't get ahead of it and why earnings can be difficult, we could have a company, Facebook, for example, Meta, and you just think everything's normal, there's nothing interesting that's going to come out. And so you don't really add to your position or cut your position, right? And then all of a sudden, good news or bad news, one way or the other, and you'll see what's called a giant window open on trading, where, if it's bad news, it closed here, and the next morning it opens down here. There's nothing that we can do about that. There's no trading after hours. There's nothing to get ahead of that. So you either guess on earnings, or you're subject to whatever the result of the earnings is on price. So it makes it very interesting. And thankfully, last earnings season, we only had a couple negative, real
big misses.
Yeah, a couple of really bad ones. Actually, a couple of really nice ones too that popped up. We had one today too that had it was company specific, not earnings, but it was just so sometimes that makes it interesting. I tend to lean, I guess, a little bit more on the bullish side. I'm hoping for good news, but we definitely doing the due diligence on our companies that we hold before earnings season is definitely a priority for us, and what we'll do at the end of the year.
We're also going to go back. Look, this I will never apologize for being too conservative. I will always say that our job is to try to control costs, or certainly control losses where we can. And my attitude is we've always been able to make it up in following years. But with that being said, a couple of things that Stephanie are going to be watching very closely. Number one, the really weird thing this year was what we call index divergences. And when you have two very well-known indices, just the Dow and the S&P 500, that have vastly different performance within the year, and yet many of them have the same stocks, it makes you wonder what really went on. So here's the point. What we learned is, and we have used hedges before in volatile times, we're going to broaden out our hedges to not just be dependent on the S&P 500. We're going to use other things. Number two, our tolerance for stocks that are missing is low. They start missing badly, we're not going to be giving a big forgiveness window here for them to get back on track. The world calls for something different. Yeah. And then I would also say too, I'm still a very big believer in the January barometer. January will set the tone, and it will be interesting to see if we have a strong January where this rally continues going forward, or it does begin to stop or to backstop based on what news might be coming out from geopolitical things around the world. But I would just bring this up. I know that we've been using money market accounts for people that have wanted to keep cash on the sidelines. Stephanie just alluded, you should expect money market rates will go down in 2024. So let's say you're getting 4% right now. I don't think it will be 4 by April. I think it's probably going to be in the 3s. So it's okay to park money there temporarily, and certainly we want to stay ahead of inflation, but it's not meant to be an investment.
It definitely not long term. It's supposed to be for cash management. I think people kind of lost sight of that, where they're like, oh, in money markets, it's an investment. It's not. It's to park cash. I have a liquidity issue that I might need the money for. I don't want to be fully in the market because the market makes me nervous or something like that. It's not supposed to be an alternative, right?
Yeah,
just fun.
Well, and obviously we're battling the same thing everybody else is, trying to keep the value of money constant in an inflationary world. So anyway, I just think that we should be, again, let's hope that some of the weirdness that we dealt with in certainly 2022 and 2023 is over. It's like the old adage, you hope for the best, but you plan for the worst. And Stephanie are it's the old adage, game on. We're both old athletes from college, so game on. We're ready for the game. One other quick thing I want to bring up, though, housing. I get asked a lot about housing. And as you all know, we do have a housing index that's actually on Morningstar's database. It's been interesting to watch. The housing stocks, which we own several of them in your portfolio, have actually been moving up. REITs are moving up. And I was shocked to see commercial REITs, with all the bad news about commercial real estate, that these are moving up. The other thing that I track are commodities, and it's interesting to see that construction commodities, lumber and copper and cement, those things are all moving up. So one of the things one of the big benefits for all of us next year who are homeowners is that now that interest rates are stable and mortgage companies can get a real good idea of what they want to put mortgages out to people in, I think we'll find the housing market will actually stabilize and probably could do quite well next year, in spite of the fact that maybe mortgage rates are not going to be certainly dropping very far, but at least we don't have to, the mortgage companies are going to be a little more expansive with credit, which again, and I'm going to finish on this note, bull markets don't start when the punch bowl has been taken away. They usually don't start when the punch bowl is nowhere near them. But one of the things that might be the very interesting trigger about this next run in the market could be the availability of commercial credit at the banks. Not so much the Federal Reserve, but what the banks are doing. And the banks are in the business to lend money. So if they grow comfortable that the Fed is done, you might find that commercial lending can pick up, and that, there we go. The economy is going to be running very well, and it's not going to be dependent on government programs to make things move.
Well, one of the things though that we were talking about just yesterday, I think, was the fact that out of all the sectors in the industry, in the market, 4 of them are demonstrably underperforming.
Oh, terrible.
So, and then you can't really have a healthy bull run with that. So we also want to see some normalization in the sectors, the multi-sectors.
Yeah, I'm still very hesitant to call this a bull market. It's been a very nice relief rally. It's been the mother of dead cat bounces, as I've been calling it. And certainly we're glad that it happened. But with that being said, it's caveat emptor. You have the old Latin phrase, let the buyer beware. So you want to be very careful not to buy into things so much and wait and see how things play out. We typically don't get into political things, but I would just say this on the political thing, on the political nature of things. The Federal Reserve does not like to sway elections. They don't like to be accused of it. They'd like to stay away from it. So I actually would not be surprised to see the Fed get very, very quiet, really from April on. And I'm talking about the governors, the various Fed presidents of the districts of the Federal Reserve. Again, they are trying to stay out of political crosshairs of investigations. And then, mark my words, one of the themes that's going to be coming out this year, there's still a lot of talk about why money market rates at banks and brokerage houses are still so low compared to money market rates. And I dare say, I think that could actually be a political football this year. Are the banks and the brokerage houses really taking advantage of investors? We'll have to see.
Sure. A couple housekeeping items. One of the things that we're going to be doing from now until the year end is checking for anyone that needs to do tax loss harvesting. If you have any concerns about your account, obviously we can take a look at it. I'm going to scrub everybody's portfolios and see if anything needs to be done just as a one-off. And then I think for us getting ready also for next year, when you have a run like we've had lately, the dead cat, the mother of all dead cat bounces, a lot of companies tend to take profits in January, and there can be a pretty large rotation. We saw that 2 years ago, so I definitely want to keep an eye on that, make sure that we don't get caught behind some massive money market, mutual fund company dumping shares. So that'll be something we definitely keep an eye on for next year as well.
One of the things that we're very happy about is that we're now done with the Schwab TD merger. I wanted to say very quickly, I know that many of you watching this were very frustrated. We did the best we could. I just hope you know, we really tried.
We were frustrated too.
I went back to the conference in Philadelphia to hear what Schwab had to say about things. Of course, they were doing a very apologetic that things were not going as well as they had actually hoped that they were. But anyway, the point is, we're done now. When we run our year-end reports, I think you'll find that your statements from Schwab and your statements with us will gel very well together. Certainly, if you have any concerns or questions, let us know. But I think now we can just get back to a more normal situation.
Yeah, and on the administrative side, I also would just say that I believe all the RMDs are done for the year. If not, maybe there's 1 or 2 left that still need to get done. So Amy and Mindy have been working really hard to make sure everything's all nice and buttoned up on that side too.
Absolutely.
Yeah.
So listen, everybody I know it's, certainly we know there's a lot of troubles around the world, but we hope that in your corner of the planet, we wish you and your families the best of holidays. Hope you enjoy a wonderful time, and let's hope that we can move into 2024 and smile a bit more. So anyway, take care, everybody.
Happy holidays.